Let's talk about the inflation numbers here. The June consumer inflation comes in at a 6.5-year low of 2.1%, lower than CNBC-TV18 poll of 2.3%. Now, to look at these numbers, here's the editor's take with Latha. Latha, morning.
Good morning. Yes, an ultra-low inflation number. It's a 6.5-year low, the lowest since January 2019, just for the record. But importantly, it's been dragged down by food inflation. We can't even call it food inflation because it is deflation. It is minus 1.06. Prices have fallen by that much year on year. And the CNBC-TV18 poll actually expected flat, 0.1% rise. But this has come in deflation. And remember, the WPI also threw up a deflation in food. It's something we have to watch. To be sure, there is a high base, but this is an important level. The big fall is coming because of even month-on-month falls in cereals and pulses. Normally, by June, this fall in prices stops because, there is monsoon dislocation of, supplies. As we look at veggies, veggies are up 7.5% month-on-month, June over May, which is normal. I mean, because, again, supply dislocation, vegetables begin to rot. But if you look at the year-on-year, vegetable inflation is down by about 17%. So that's the extent to which food is not an issue. Core CPI has come in at 4.4%. Core is when you take out food and fuel, whatever is left, largely services. That's come in at 4.4. That also because it includes gold. That's also because there is a low base. All this base will evaporate. Even gold will plateau on year-on-year terms. So we are going to see core inflation also falling. The expectation is July is going to be below 2%. 1.8 is kind of the dipstick survey for me. And there was one person with a reading of even 1.5%. So that's the kind of low for the full year. Most people are now looking at, below 3% below 4% for all of 2025 calendar. For the full year FY26, people are now looking at 3.3, 3.4. 12 month, that is 3.3, 3.4. RBI is standing at 3.7. So now the market is pretty sure there is space opening up for another cut. And more importantly, that liquidity will continue. See, if too much money is not pushing up goods prices, that's what you normally worry, too much money chasing goods and pushing up prices. If that's not happening, then, the Reserve Bank will be more relaxed with liquidity. So chances are we are going to, start seeing the bond market pricing in a rate cut. Yields didn't fall yesterday. They were open. The bond market was open when the numbers came. Yields didn't fall. That was because of US yields going up. But space for rate cut is clearly opening up.
OK, all right. Thanks a lot for that, Latha.